Again, thank you for joining our webinar today. Sorry about the little technical difficulties. Real quick intro for me, I'm Mike Hardy. I'm president and CEO of Top Software. If you're not familiar with Tops and what we do, humor me for a couple seconds, I'll tell you about us. Our goal at Tops is to unify the entire HOA ecosystem. You know, we have been in this industry now for several decades. We know how tough it is to do the business of community association management. There's multiple constituents that you guys work with, a lot of demands. You've got owners, you've got board members, you've got vendors, you've got business partners. And at the end of the day, all of those people have discrete needs that you need to serve when you're working in the association. And that oftentimes means that clients are forced to use a lot of different tools. Our vision, our goal here with Tops and with Tops One is to bring all of those people together into one ecosystem where everybody has access to all of the essential information that they need in real time, giving you complete transparency and also reducing the need for you guys to have duplicative systems. So the net of that is more work, more quickly, less cost for the association. When we think about the different pieces that we bring to the table, you know, we really are starting with the foundational level of giving that accounting and management system of record. And on top of that, we can layer on our financial services team. We can help you automate your AR and AP payment capabilities. We give you tools for different levels of resident engagement, from portals to websites and SMS and email messaging. And then finally, we bring the vendors and other kind of key external parties into the mix with AP online submission and digital AP payments. So again, the nice thing is we're not trying to scratch like the kind of oddball itch within the association. We really do focus on the things that 100% of communities across the country, regardless of size, 100% of the needs that all communities have. The other big thing that we do that kind of sets us apart is that we built our applications to be completely mobile responsive. What that means is that whether you're using a phone or a tablet, a Mac or a PC, it really doesn't matter, because no matter what device you're on, as long as you've got an internet connection, you're able to log in, you're able to access key information and perform every single function regardless of the device you're on. So you don't need a separate app to download. You don't need to have a certain type of operating system. Tops One and our entire kind of suite of products is completely portable across every single application that, you know, chances are you're using today. So again, that's a little bit about us. If you're interested in learning more, send us a message in the chat. Happy to reach out to you guys after the fact, give you more details about what we can do and if there's a good fit to help your organization out. That being said, I'd like to take a moment to introduce our presenter today, Vishu Sharma. Vishu, welcome, and thank you for being our presenter today.
Thanks, Mike. Looking forward to it.
Yeah, it's good stuff. So you know, you can read a lot about Vishu's credentials, but you know what I think I would kind of say is that he's somebody who's been dedicated to driving community accounting forward, helping to train, helping to set a lot of the kind of best practices and guidelines. He's a real thought leader in the space. We're really fortunate today to have him talking about kind of budgets and avoiding some of the pitfalls that we can easily fall into this time of year. So that said, Vishu, I'm going to turn it over to you. But before I do that, one last thing I forgot to say. You may have questions throughout today's webinar. If you do, there's a little question box within the panel off to your right. If you are able to, go ahead and put your questions in there, and our team will sit there and we'll try to address them in real time. And if we've got time at the end of the webinar today, we'll also be able to kind of maybe ask Vishu some of the questions you guys put in that box. So please use that box to submit questions to Vishu today. All right, with that, Vishu, I'm gonna turn it over to you.
Great, thanks, Mike. So as Mike said, Vishnu Sharma, I'm a CPA certified fraud examiner. My background prior to getting into this field was in internal external theft for retailers. So I used to develop programs for Bed Bath, Sports Authority, and other corporations publicly held. Got into this field back in 2005, and I've been now in about what's going on 16 years. So our team down here and in California handle something about like 50,000 doors in day-to-day bookkeeping and accounting, as well as both for management companies as well as for self-managed associations or associations that have in-house management. Let's go ahead and jump right in, Mike, on the introduction. Budget season is probably second only in joy and fun to a manager outside of election season. It's just that much fun. There's an entire process through it. I mean, those of us who've been through it any number of years, it's pretty tried and true, especially if you've been with the same organization for a period of time. You have your budget templates from prior year, and then you can kind of run through that process. For those who have not, however, and you're with a new organization or you're having to learn something new, and then there's some that just have a really difficult time when it comes to budget season because it just doesn't make sense. What we try to do today is through 16 years of doing this, working with hundreds of community associations over the years, and going through literally thousands of budgets. There's just certain practices that we see that people get tripped up on, and one, we see it on the audit side when we have to do year-end audits and there are issues with the budgets that are presented, and we end up having to do an internal control note for the management to let them know that, hey, these are some errors that we found as an internal control matter, or in actually doing the budget itself. When we get the budget and we realize that, look, you budgeted reserve interest income as an operating income and you can't. So what we're trying to do is just from best practice of what we've seen out there and common practice, here's 10 things that we're seeing that if we can call out to you, might make your season a little bit better. So let's go ahead and jump right in. So the first thing I'll tell everybody is know your statutory and declaratory requirements. So, and I'll reference, I'm based in South Florida. So the state of Florida is probably one of the most regulated states in the community association space. Outside of probably Virginia and California, we are probably one of the trendsetters of what you'll see for legislation. I will make certain references to the state of Florida, but only in reference in passing. The rules that I'm providing guide you for any budget that you're doing. But just kind of to bring home and flesh out the point, when you're looking at it, you can go back to the next slide then, Mike.
Yeah, like I'm getting a little bit of an issue with kind of go to a webinar today, so I apologize. It looks I'm advanced on this side, but I don't know if it's
moving. I'm seeing
on
number one, know your statutory doc requirements.
Okay, that's what's on my screen. So yeah, I apologize.
No worries. So budget elements, depending on where you are, and you have to understand that there are regulatory requirements that your state might mandate, and there are regulatory requirements that your declaration may mandate. The way it generally works is that if your state requires it, then you have to have it as a component. However, your declaration may call for a higher standard. So for example, budget meetings. The state of Florida, for example, requires a 14-day notice. I have associations that have a 30-day notice requirement. You must follow your declaration. Now, keeping in mind, I'm not giving legal advice at any point during an entire presentation. So anytime you have a question about what is statutorily required, what is required by your documents, got to see legal counsel, make sure that you understand. And if there is a conflict between the two, you definitely need to make sure that you're reaching out to legal counsel, get something in writing as to what it is, and just save it on file. One of the common things we get is when it comes to reserves, and you have to do your reserve and you have to figure out your vote. Every year it's the same thing, but is it a majority of all owners? Is it a majority of a quorum of owners? Who knows? That's what legal counsel is for. Let them read your declaration, let them decide what it is, and then get that number. Once you get it, save it, embed it into your Excel file or your budget documents so that you have it every single year in reference, and that you don't need to go back to that expense or to that reference every single year. So just making sure that you know what's the deadline. And we'll talk about a new requirement here in the state of Florida. What's your requirement for mailing out your notice? What elements have to be in your notice? So for example, in the state of Florida, you're required to not only have your notice, which has to have the date, day, time, and location of your meeting, you have to have a copy of the budget. The level of detail in the budget is prescribed by statute. that you have to have a reserve schedule is prescribed by statute. So all of these things you need to make sure. Funding of reserves. Make sure you know what the requirement is for funding of reserves. In the state of Florida, for example, we're required, a condominium association is required to present a budget that fully funds reserves. And that can only then be waived by ownership or partially funded by ownership. You don't have that right as a board level in a condominium association in the state of Florida. So whatever state you happen to be in, just make sure you know what the rules are and the regulations. Okay, Mike, next. So I've given you two examples here. This is the first of two. So this is just FAC. So everybody knows that there's a statute, but depending on the state you're in, there's also going to be an administrative code possibly. And the administrative code is simply just the next level of detail. So the statute sets out what the general guidelines are, and the administrative code would be the government body. In the state of Florida, it's the Division of Condos. For the DBPR, which is the Division of the Department of Professional Business Regulation. They set out they flesh out the statute. And here, for example, is the Florida Administrative Code that governs budgets. And it tells you what your criteria are. You have to estimate your common expenses. There's got to be a beginning and end date. I will tell you, the state of Florida, for example, we have a division of condo that enforces things. If your budget goes before the division and it doesn't have that your budget is January 1st, 2021 through December 31st, 2021, you're going to be found not in compliance. It can be that technical. So just make sure you're understanding exactly what the rules are. Total ownership assessment for each unit according to proportion. Dealing with an association right now where they came to us for an agreed upon procedure where they had a special assessment that was passed and everybody was assessed exactly the same amount, $100 across the board for every single one of the 200 units. The problem is they have percentage of ownership. You have 1 bedroom and 2 bedrooms, and it never should have been done that way, but it was done that way. So now new board's taken over, it's getting corrected, legal counsel's involved, we're involved, and we're trying to unravel the mess that was 3 or 4 years in the making. So there again, proper planning in front saves thousands of dollars on the back end. And then in the state of Florida, as I mentioned, they actually list out what your expenses need to be, the basic expenses. So they will give you a list. You don't have to have all of them, but if they're applicable, you have to list them out. Next, Mike.
You got it.
For everybody in the great state of Florida, something important to understand, and for everybody else, just as a general knowledge, in the state of Florida, for example, we have that you're required to do a budget every single year. There's never been a date on which that budget needed to be prepared. And because of that, what ends up happening is we have associations that are in January, March, April, May of the actual current year, and they're now passing the budget for the current year. So we have 3 associations that have passed their budget this year, January, March, and April of this year. And they had just come to us within the year, and we helped them through the process. But you can't now anymore because by statute, the law was changed July 1st in the state of Florida that your budget now has to be in place at least 14 days prior to the start of the year. There's not a whole lot of teeth behind it just yet because it's still vague as to what the penalty would be. It's deemed a minor violation. So what that means, with the division as to how they enforce it, whether it's a small fine or simply a reprimand and a reminder you need to do it, don't know, but don't put yourself in the position. Your budget has to be done. We guide all of our associations that are on a calendar year basis. Your budget should be approved by the board formally no later than the first or the second week of November, because then that gives us the opportunity to go ahead and order the coupons for all the owners. And it's going to take a 2-week process at the end of November because it's Thanksgiving and everybody else in the country is ordering their coupons from the same 2, 3, 4 coupon vendors that run the whole country basically. And when you do that, you're all going to South Data, you're all going to whoever the different companies are, but there's only a handful of them that do this business. So when you go to them, you're going to go to them and then you're hoping that you can get the coupons out to every owner by the first week of December. That way, every owner has correct notice that if they have to make adjustments to their bill pay, their ACH, or anything else, they can go ahead and make those changes and have sufficient time. So super important to make sure that everybody in the state of Florida knows that, but everybody else, make sure your budgets are done well in advance of the end of the year and you have enough time to order the coupon. So your deadline should be the first week of December. Every owner should have the coupon book no later than the first week of December. Next one. Zero-based budget. How do you start your budget? We get this question all the time. You do not simply take a look at last year's budget, put a percentage on 3%, and then, you know, to your actual, and that's what your number is. It doesn't work that way. You've got to start from zero, start from the beginning. Your budget has to be a zero-based budget, line by line. And there's no way to do it that's a shortcut. You have to start from the first and you have to work all the way down. Start with your income first, figure out what your miscellaneous incomes are going to be, and be realistic, and then get down to your expenses. But you have to start from zero. When you look at your expenses, and we'll talk a little bit detail in the next slide, but payroll schedule. When your payroll schedule, you have to build a schedule for your payroll. Name of the employee, what department are there, what's their current pay rate, are you anticipating an increase, and then what's their new rate going to be next year, right? And then you run that out, and then you take your payroll taxes off of that number, but you have to have a schedule. You can't look and simply say that in receiving this year, we ran, you know, $300,000 and we think we're gonna, you just put in like a 2%, you know, possible increase for everybody next year and go to 408. Doesn't work that way, because in the given year, you're going to have attrition. You're going to have somebody that was let go in February and you didn't rehire that position for 3 months later. So that means you're going to have a 3-month gap. So if you're basing next year's budget based upon the actual for this year, you're going to severely under budget yourself. The other thing to factor in is overtime. Make sure that you understand, does your association allow overtime? And if your association allows for overtime, great, then make sure you're factoring it in. If your association doesn't allow for overtime, make sure you're factoring that out. There's no point in factoring in numbers, and don't be too complicated on your numbering system. We'll talk about that a little bit later on the GLs. But the other final thing on this particular slide is your budget must net to zero. You're a not-for-profit. You cannot have a profit. You cannot budget for a profit. And most importantly, you can't budget for a shortfall. You know, we come across budgets all the time where we have somebody who's budgeted a gain or they've budgeted a loss. Can't do either one. It has to be a zero sum at the end of the year. Okay, next. Don't over budget or under budget, right? Don't over budget income or under budget expense. Massive failure on over budgeting of income. If you over budget your income, you've automatically built yourself a loss for the year. And we see this most often in income, in late fee, for example. Associations have policies where they allow, for example, if you have a good payment history and you've missed one payment in 6 months or one payment in 12 months, they will waive as a courtesy that late fee for you. There are other associations where you'll charge late interest, and then you'll get into an agreement with the owner and you will waive the interest as a courtesy in order to get paid back everything that you need to get paid. When you calculate or you look at what you've charged for late fees during the year, you can't be budgeting that 100% because you're never going to collect your late fees 100%. You should be budgeting 50% of that number or less, because otherwise you're booking stuff that you may not collect. And even if you did manage to collect 100% of it, you never collect your late fees in the same year. It's metered out over multiple years because you have people who are going to owe you, go to collections, and you're not going to collect that money for another year, 2 years, whatever it is. So you just need to make sure that you're not over budgeting. Don't be aggressive on it. If you're looking at rental, we have a number of associations over the years that have been successfully able to foreclose on a unit, take title to that unit subject to the mortgage. So while they're waiting for the bank to foreclose, they're able to actually rent out and make money on it. Well, if you're renting it out for $1,000 a month and you're budgeting, you can't budget $12,000 for next year because there's no way you can guarantee that you're going to get all 12 months, that the bank won't foreclose in the 3rd, 4th, 5th month of the year. So just budget conservatively on income and you won't have a problem with a shortfall. The number one thing to know too on there, don't budget reserve interest. Reserve interest belongs to the reserve fund. Check on your state. That might be a state by state, but in the state of Florida, for example, reserve income belongs to the reserves. You cannot budget reserve income and use it for operating expense. It has to stay in the reserve fund. Just did a budget today with an association. It's our first year doing their budget with them. They had $32,000 in their budget for this year that was reserve interest income. That's a zero on that line. They had a built-in $32,000 shortfall on their budget this year. And what's worse is not only was it bad for this year, next year when we do the budget, which we're doing right now, we put zero in that line for next year, which means they automatically have an increase in maintenance because I had to take out that $32,000 line item that was budgeted for last year. So they have a built-in gain to next year. So they didn't get the money this year, and now it's going to show as a gain to every other owner, or an increase in maintenance to every other owner for next year's budget. Even if they manage to keep everything else flat, they have a $32,000 increase in their budget. Okay. Know your expenses. There's two basic categories. Condos and homeowner associations, for the most part, are very straightforward. You only have 5 categories. You have your administrative expenses, your repair and maintenance, your utility, your insurance, right? Those are what we call your estimated expenses. Your known expenses, basically contract and payroll. Your contract expenses should be a lock. So when you look at your budget, you should have 5 or 6 sections in your actual presentation. And your contract expenses should be things, your AC maintenance contract, if you're doing an annual fire inspection, elevator contract, if you are outsourcing your accounting, if you have valet, if you have housekeeping, any of the things that you've contracted out as a service, you're going to want to make sure it's in contract, because when I do my budget, I do my actuals in my financials, I should be able to go through the contract section of my income expense statement, and those numbers better tie out. Because if I know that I have a contract with cable TV and I've budgeted correctly and it's $15,000 a month, I should be within about $100 of that number every single month. So when the board reads it, when management reads it, you should be able to look at the contract, and if something is $1,000 or really way off, you should be able to immediately pick that off and say, wait, something's wrong in contract, because my budget and my actual should be pretty darn close to each other. Payroll's the same thing. For the most part, you should never be over budget on payroll. You could be under budget on payroll if, for example, you lose somebody, or you're able to replace somebody existing that's a higher rate with a lower rate. You should be able to, come into that number. But contract and payroll are pretty set numbers. The rest of them, however, utility, you have no idea what your utility is going to be or what the increase is possibly going to be. In the state of Florida, our municipal governments run on an October 1st through September 30th date. And I think it's most municipalities in the country run that way. But for everybody that runs October 1st through September 30th, if I'm putting my budget together, it's September. I'm doing my budget from now. And when I do my budget from now, one of the challenges I'm having is, as I do my budget, I should have my budget in the can and before the board by the end of this month, right? If I'm thinking of my timeline, I should have that, and if I have that in there, I may or may not be able to know what that actual increase is depending on the city or the county that I'm located in. But you do your best to be able to find out what that proposed increase is going to be and what that's going to look like. But there's no way to gauge what usage is going to be like, if it's water, if it's utilities, things like that, electricity. So you do the best you can using historical. So the estimated expenses, you're looking at a rolling 12-month of historical to see what you are. You can go back farther than that, but the challenge that you have the farther back you go is you're going to have things that might have happened in 2018 or 2019 or 2020 that are not exactly relevant to what's going on today. So you can look and you can say, wow, in 2019 we were this number and today we're this number. Well, the rolling 12 months is usually a pretty good way to look at it. You never want to not look at 12 months, and a rolling 12 months gives you seasonality. So I'm using the word rolling 12 months, and a rolling 12 months means not simply taking January through July and then forecasting forward on that for 12 months. So traditionally what you would do is you'd say January through July, figure out what that total number is, divide it by 7, and then multiply it by 12 to project out for the full year. A rolling 12 months is much better because, for example, in Florida and other places in the country where you have seasonality to your residents, we have a massive influx in the holiday season. So your water, your electric, your valet costs, all these things are going to go up during the holidays. So if I'm doing 12 months and I'm not doing a rolling and I'm only doing January through July, I'm not going to capture that heightened level of activity that you're going to see around the holiday season. So if I'm doing a rolling 12 months and I go from August 1st last year through July 1st of this year, now I'm going to capture a full 12-month cycle of the life of the association as far as the expense, right? So administrative, the same thing, utilities, repair and maintenance. Repair and maintenance is a crapshoot, and everybody who does a budget knows that. You don't know what pipe is going to break. You don't know what motor is going to fail. All you need to do is be realistic. Do not have a true expense in 2021 of $80,000 and budget 35 for next year, right? One of the greatest epic failures that we have in the budget process, and every manager out there, every accountant and bookkeeper out there that deals with budget, the death knell of a budget is when the board comes to you and says, before you've even started the process, and says, okay, I don't want an increase this year. Well, why do a budget? If you don't want an increase this year, I'm just going to copy the same one from last year. We'll carry it forward and everybody's maintenance will be the same. What's the purpose of doing a budget if you're going to dictate that we're not going to do an increase? Everybody in the state of Florida right now is living through insurance hell, right? We're all seeing 25% or greater premium increases, at least we are in South Florida. And I have to imagine not only the rest of Florida, but other parts of the country, because we've been told there's only so many reinsurers in the country. So whether you're wildfires in California, whether you're floods or snowstorms in the Northeast, whether you're hurricanes and tropical storms in the Southeast, it all pulls up into one giant, set of reinsurers that spread that cost and that pain across everywhere else. So we've seen some massive increases. I've had associations that have had to pass special assessment one time in the middle of this year just to be able to cover $100,000, $200,000 increased premiums for their insurance. Yeah, it's stunning what we're seeing out there right now. I have associations that have had 25% back-to-back year-over-year increases in their insurance premiums. So just understand the best you can what your numbers are. Everybody, we all go to our insurance agent. We say, okay, what do you think it's going to be next year? And they all give you the same standard, book for 10%. And everybody who booked for 10% got caught because nobody realized how bad it was going to be this year. So, okay, next one.
Yeah, I mean, can I just say something on this real quick?
Yeah, please go on.
I think this is such an important point you're making with kind of the income and expense, and you say realistic approach to expense. Let me ask you. I always kind of take almost like a pessimistic approach on expense, like worst case. Is that right to do, or to kind of think like, hey, worst case, like these things are going to be high, insurance, that's how I always kind of think about it. Am I right thinking about it that way?
Yeah, you are in a way. The challenge becomes the reality, and everybody out there who does their own budget, they know what it is in the world of a condo. You're going to be restricted. You're going to be restricted as to the level of increase that you can pass. And the problem with repair and maintenance is anything could go wrong, right? And when you're dealing with a 30, 40, 50-year-old building, you're having pipe breaks all the time. You're having mechanical failures all the time. And if you're not maintaining your building to the best that it could be maintained, you're going to have more of those. And it always becomes a pricing pressure where the manager will hopefully present to the board, this is my realistic budget. These are the projects that need to be done. And we're going to talk, Mike, I think what you're asking about is a great point for later on, where we're going to talk about capital versus operating, right? So separating out the concept of what is a repair, a true repair, versus a capital cost or a replacement cost for the budget. Because I think what tends to happen is there's some confusion between those two, where capital costs of replacing are added to an operating budget, and that distorts the nature of the operating budget as well.
Got it. Okay. Yeah. All right.
Mike, do you wanted to do that second poll question?
You know what?
We don't have Sandra, right?
I don't think we have Sandra, and go to webinar. is really acting up. So the fact that we're broadcasting, hopefully we're broadcasting. I feel like right now I can't actually do anything else with the UI. Like the entire UI is frozen up for me. So we'll have to skip the polls on my side. And if this thing fails, I apologize in advance. I'll log back in as quick as I can.
Okay, no worries. Okay, so operating expense and capital, it was actually our next slide, so that works out really well. So operating expense, what do you need to do to run the day-to-day of the association, right? Legal fees, accounting fees, your mailers, your postage, those are your administrative type expenses, your utilities, electric, water, gas, right? Repair and maintenance. Repair and maintenance refers to repairing a part that may break. It doesn't necessarily cover the cost of replacing it. So when the elevator motor blows out and it is $50,000 to repair that motor, right? That's not an operating cost, and that's not something that you necessarily factor into the day-to-day operating budget. That's capital. If the association wants to and is willing to go ahead and fund that as a separate part, it should be below the line. You should have all of your operating expenses net out to zero, and then come up with what you're going to want as a capital project list. And then you would fund those, and if you want to fund them as part of the budget, you're welcome to. But just make sure you keep separate what's operating in nature and what is a one-time expense. There are certain regulations in certain states. State of Florida, for example, we have a rule, and the law says that if your budget is greater than 15% over the prior year, unit owners have certain rights that kick in at that point. However, to get to that 15%, you have to exclude one-time expenses, you have to exclude reserve funding, etc. So there's certain components that come together. So it's super important to keep operating and capital separate. Also, reserves. Capital budget is the territory or the domain of reserves. Every association should be allocating and setting aside for reserves, whether partially or fully, they should be setting aside for reserves. In the state of Florida, as mentioned earlier, it's a mandatory requirement for a condominium, not an HOA, but for a condominium, the board must be passing a budget that fully funds reserves. And you have to have a proper reserve schedule that allows them to calculate what full funding of reserves, and the statute declares what's considered a reserve. So there again, all of these things are dictated by statute. Any number of declarations of condominium have that as well. So you need to make sure that you're up on what your rules and regs are for your state or your area, as to what was required both by declaration and by statute, right? Now, that's it for that. We'll move on from that topic.
All right.
Funding prior year deficit and using prior year surplus. Super important conversation that comes up every year. Board member comes up and says, or an owner comes up and says, wait, you guys had a $100,000 gain on the books this year. Why are we not rolling it over into next year to reduce our spending next year? Aren't you required to do that? So I'm going to take deficit first, and then we'll talk about surplus. But they both follow the same concept. And the separation from an accounting concept I need everybody to understand is this. Separate the concept of a gain or loss on your income statement from what your cash position is. I can have a $100,000 gain on paper on my books. I can have $10,000 cash in the bank, right? So if I have a $100,000 gain on my books for the year showing that I have a gain, and then I turn around and I go to my bank statement and I have $10,000 cash in the bank, it's because I have receivables of $80,000. So I may have turned a gain, but just because I have a gain doesn't mean that all of that relates to cash dollar for dollar. It doesn't, because depending on the state you're in, you're required to follow from a GAAP basis. Forget statute, forget everything else. By GAAP, by generally accepted accounting principles, you're required to use accrual accounting. Accrual accounting says, I'm booking my income based upon when it's due to me, not when I collect it. So if my maintenance is $100,000 a month for 12 months and my budget is 1.2 million, on the first day of every month, if I'm monthly maintenance, I'm recording $100,000 worth of income. My actual is going to be 100, my budget's going to be 100, and my variance is going to be 0, because the offset to that 100,000 is my accounts receivable on the balance sheet. And then when owners pay me, I'm going to reduce my receivable, right? So it's going to show that I've collected 100,000, but it's not. I didn't collect 100,000. It's just I've earned 100,000 that's due me, right? So my gain of 100,000 isn't necessarily tying to cash. So before you decide that you have a surplus or a deficit that needs to be funded in next year's budget, understand your cash position. The other concept to understand with all of this is every association should be running with 1 to 2 months worth of operating cash equal to their budget. So going back to the example, if your monthly budget is $100,000, you should be sitting with $100,000 to $200,000 cash in your bank account at the end of any given month, because no association should be running on 0. You have to have cash to pay your bills the first of the month, the third of the month, the fifth of the month. We all have large bills, whether it's the insurance premium that has to be paid, whether it's the utility bill that has to be paid. They're large bills, whether it's payroll that has to be made. They're bills that are going to be due that first week. If you're running on fumes, where are you getting the money to go ahead and pay those bills come the beginning of the month? So you should be making sure that you have 100 to 200,000. So if you have a gain of 100,000 and you have cash of $100,000 in your bank, you do not have a surplus to roll into the next year, because that 100,000 that you're sitting with cash is what you need to operate your business, because a condominium association is a business. The same way we hopefully don't live where the end of our month comes and we have no money in the bank and we hopefully have a cash cushion to carry us into the next month. Every condominium association is a business. It has to operate with a float. It has to operate with a cash cushion, and that cash cushion should be 1 to 2 months worth of operating expense, right?
Vishu, on that point, yeah, I've talked to many clients over the years that maybe the communities run a little bit more hand to mouth. Is that typical in your opinion?
Yeah, it's a shame.
Payables, stuff like that.
You'll see them that you see those associations that run with very little cash, and they might have a week or 2 weeks worth of cash. Mostly what you'll see is the auditors, when they come through and they do the year-end audit or the year-end financials, they will call it out as a point of internal control that an association should maintain. And I've seen anywhere from 1 to 3 months recommended. And I'm not limiting it to only 1 to 2. If you're comfortable with 3, keep 3. The more the better. I have 2 or 3 associations out of 85 that I deal with day to day that actually have enough money kept aside that every year when their insurance premium comes, they pay their insurance premium in full and they save the cost of the interest. And if you think about how brilliant that is, you're getting nothing on money that's deposited in the bank, 25 basis points, 50 basis points if you're lucky. And for an association that has actually accumulated that money, they're saving themselves 2, 3, 4% that they would be paying to finance their insurance cost. So the return on investment of that money that they're holding is just tremendous. So
yeah, that's a good point.
Contingency versus miscellaneous. Pet peeve: miscellaneous. There should be no miscellaneous. There's no miscellaneous income. There's no miscellaneous expense. You don't budget for something you don't know, right? So miscellaneous, the only time you should be using miscellaneous is if you have an expense or you have an income that occurs in a given year that you truly cannot fit into any of your existing budgeted lines, fine. Then if you want to create a miscellaneous for either income or expense, you put it there and just understand how you can explain the nature of that expense. Contingency is a little bit different. Normally, I prefer to see contingency added to individual lines. So if you know repair and maintenance and you're estimating, put your contingency in your repair and maintenance. Put your contingency in your legal or your utility. Whatever it is, factor it into the existing lines you have. If you would rather and just have a single line that is your contingency, fine. You put a contingency line, but the understanding is you never ever book an expense to contingency. Contingency is not an expense. Contingency is simply a line that you've put in your budget to give you the flexibility to go over budget on a particular line. Repair and maintenance, plumbing, AC repair, whatever it is, right? Now, when you code your income or expense to miscellaneous income or expense, okay, I already covered that too. So, and then your contingency. So we're good with that.
Keep going.
Yeah. Contract and repair. So contract and repair, these two get blurred all the time, and they really need to be separate. And there again, I'll tell you, you're the manager, right? It's your budget. You decide what's comfortable for you, that people are going to understand it, but you have to be consistent with whatever you do. I explained earlier contract expense. Contract expense, in my opinion, to my viewpoint, would be strictly what's the cost of the contract, and that's what I'm booking. If I have an elevator contract and my elevator contract calls for $1,500 a month, I'm budgeting $18,000 a year and I am booking, and normally you pay by the quarter, and then you're booking it as a prepaid expense, and every month you're recognizing that expense. But my expense should be $1,500 actual, $1,500 budget, and zero variance. If when Schindler or Otis or anybody else comes out and they're doing the work, they say, you know what, you've lost this module, you've lost this panel, we need to do the repair is going to be $1,800. Great, do the repair. Do not book that repair to contract expense. Book it to elevator repair under repair and maintenance. Don't blur the lines, keep them clear. Contract expense, repair and maintenance, repair and expense. Just because it's the same vendor, it's the same component, don't mix them. Keep them separate, because what it helps you do is it helps you understand the true nature of your expense, so that when you get ready to budget and you're looking at this, you understand. It also helps your board. When your board's looking at this and they're seeing the contract expense, $1,500, they understand it, and they see elevator repair, that they only budgeted $3,000 for elevator repair, and you have $8,000 of expense through 6 months. Now, why? Okay, you know what? Do we need to do a major repair? Is it time to refurb? What do we need to do about thinking? That's the trigger that comes about. Whereas when you blur them together in contract, oh yeah, we did a repair on it, that's it. But you're never true what the real number should have been in the first place. And that's the problem with it. So that's it, contract and repair. Keep them separate.
You want me to go forward?
Yeah, please. Sorry.
No, it's okay.
Bad debt expense and allowance for doubtful accounts. Allowance for doubtful accounts sits on your balance sheet. You have an account receivable. At year end, some associations choose to do it during the year, but usually at year end, the auditor or your CPA who does your year end financials will do a calculation. And what they're required to look at is the assets of the association. And is an asset of the association impaired, right? Do you have a problem where you may not be able to collect fully all of your receivables? And if you do, they will set up an impairment charge, an amount that they think may not be able to be collected. And there's different metrics or standards. In a traditional business, it's anything over 90 days potentially, or anything over 6 months, depending on the industry. In the world of CIRAs, it depends on the state that you're in as to what the metric would be, or the CPA, their experience in dealing with the industry. We tend to default to 1%. In the state of Florida, we have a special rule that's a safe harbor, that if a bank forecloses on a unit, the bank's obligation to the association is limited to 1% of the original mortgage, or 12 months worth of maintenance, whichever's less, hence the power of the bank lobby in the state of Florida. So because of that, you end up having to figure out that if somebody owes me $20,000 in receivable and hasn't paid me in 3.5 years worth of maintenance and special assessments, I can't carry $20,000 on the books. If the value of the property is $300,000, assuming the mortgage is the same amount, I'm going to estimate $3,000 as being collectible. Everything other than that, the $17,000 remaining, is going to be written off to the allowance for doubtful accounts, right? But that's a year-end adjustment. That's not budgeting, right? That has nothing to do with the operating budget. Your operating budget has a line called bad debt expense. Bad debt expense is when I look at my future year 2022, what portion of my receivables, or I'm sorry, of my billable in 2022, my maintenance. So if I'm going to collect 1.2 million, as per my example, 100,000 a month from owners for 12 months. If I'm going to collect 1.2 million, what portion of that don't I think I'm going to collect? Because any of that I don't collect, I'm going to be cash shortfall. So my bad debt is to plug that cash shortfall. And I'm figuring on two things. I'm going to go to my existing delinquency report. What is my percentage as overall? So if my delinquencies are $60,000 and I have a $1.2 million budget, I'm running a 5% delinquency. Right? 60,000 divided by $1.2 million is 5%. I factor that 5% in for next year, and I now have a $60,000 number as a bad debt expense line. Because if 5% of the people didn't pay me this year, what's going to make me think that they're going to pay me next year, right? Now they may, and this is a subjective judgment call. You have to know your association, but that's the number you start with. Now you can modify it, and you modify it by looking at certain things. If I have a high receivable, and do I think I'm going to collect some of that this year? So let's say I'm starting out with 60,000, but of my receivables that I currently have, I think I'm going to collect 20,000 of it next year. So then I might only want to budget 40,000, right? So my bad debt expense would be budgeted for 40,000. But the concept I want to leave you with is bad debt expense is to plug the potential cash shortfall you're going to have next year or in your budget year for whatever you will not collect from those owners. Okay. Next, Mike. Maintain the integrity and coding of expenses. So I'm going to tell you the absolute faux pas that thankfully we rarely see, but sometimes rears its ugly head. I get an association, they get a bill, and the bill is for the attorney, and it's a $3,000 expense. And they do not want to post it to legal because the budget for legal is $20,000 and they're already at $21,000 and they don't want to go even farther over budget into legal. So they want to put it into professional fees, they want to put it into miscellaneous, and God forbid they want to put it in something even crazier like a repair and maintenance line item because the attorney was reviewing the contract for the elevator. Therefore, I want to put it under elevator repair and maintenance. Right? So that's an obvious faux pas. You would never, ever do that. The purpose of coding is to clearly, cleanly, and correctly represent the expense under the line item that best describes the nature of the expense. Because the purpose of all of this is so that when you as the manager or the board have to read this, or any of the owners, you can clearly understand that the cost of a particular line, whether to budget or just overall, that you're dealing with. When you get ready to do the budget, if you are not clearly coding and you're doing your budget, you run the risk of trying to look at your current year actual and looking at your future expense and saying, wait, these don't tie out. Why am I so far off? Because I know my contract is this amount, but why is this so much lower or so much higher, right? So you need to make sure that there's got to be integrity in the coding of the expense, coded to the line that you need it to be, right? Next most important thing, never, ever, ever net income and expense. Never, ever. So I get an insurance claim. I spend $30,000 repairing the elevator. I file my insurance claim. My insurance company gives me back my $30,000. I take the $30,000, put it against the insurance claim expense. I have zero. So you've had $60,000 worth of expense and activity, income and expense. Nothing shows on your financial statement. There's nobody ever looking at your financials that would ever know anything happened. It can never happen. Insurance claim gets booked as insurance claim reimbursement as an income line item. Insurance claim expense, create a new line under your repair and maintenance. Call it insurance claim. Book your $30,000 there. They wash, right? So it won't impact the budget. but it clearly shows the level of activity that occurred. Just never ever net the two, no matter what. Next. Our last one, I have a bonus for you, but this is our last official one. So adding new income and expense lines is needed. And this really picks up from the last slide. Don't be afraid to add a new line, but be judicious in adding a new line, right? I have a $4 million association, $4 million annual budget. They have a $500 line item. They have 3 of them. What is the value of a $500 line item on a $4 million budget, right? And that's the question that you have to ask yourself when you're looking to create a new line. Everybody only has the capacity to read, review, and understand so much. And in all fairness, when it gets to numbers, to budgets and audits, people's eyes glaze over after 30 seconds, a minute or two of trying to look at this stuff. If you present a P&L with 50, 60, 70 lines of detail, it's too much. It's just too much for the average person to be able to take in, right? Try to keep your lines reasonable to a number that makes sense, right? If during the year you have budgeted lines and you have an insurance claim, create a new line for it. It's a one-time expense. Or you have a capital project, you have to buy a new golf cart and you didn't budget for buying a new golf cart. Put in a capital projects, put in a special projects line. So that you can show it. It'll show up with no budget. You'll have an expense. When you get ready to budget for the next year, you'll be able to know that, look, we had this one time. Do we have to think about something for next year that's going to be a one-time? It'll be a trigger for you. It also cleanly presents your financials to whoever sees it. The other reason you would add a new income or expense line is, have I come into a new source of money, right? Or have I brought in a new expense line that I didn't have before? So, for example, an association has valet as payroll. They decide somewhere during the year that they're going to outsource valet because it's more economical to them. They don't want the hassle of dealing with the payroll, etc., and all the complications with it. Great. My payroll line becomes 0 now. I no longer book an expense to payroll. I go to contract expense, I add a new line for valet, and I book my expense to valet as a contract expense. So for this current year, I'm going to have valet as part payroll, and I'm going to have it as part contract. When I'm budgeting 2022, I'm now going to budget strictly for valet under contract, right? But now you're not morphing or hiding what you're doing, because if you keep taking the contract expense and book it to payroll, you no longer have payroll. When you have your workers' comp audit at the end of the year, they're going to want to know why you're showing $200,000 worth of valet expense when you truly only have 100 under payroll, and the fact that you have no more payroll to begin with under that line item, right? So make sure you're keeping them separate. Open up a new line. Don't be afraid to cleanly show it. Just because it has no budget, it's not a problem, right? A budget is not set in stone. It is not something that you can't deviate from. It is simply a guide based upon the best knowledge that you had at the time you prepared the budget, right? As everybody in the state of Florida knows that got blown up by insurance this year. So, Mike, let's just cover the last 2 quick slides on the reserves.
Yeah. And I think that's such a good point you're making there about, the budget. It isn't kind of fixed in stone. It is a highly educated forecast for what you think the future year is. I know that internally, when we've done budget prep in the past, there can sometimes be a tendency to kind of like think that like it has to be absolutely flawless, and we've wasted time internally trying to get the perfect budget when it ends up just being kind of a waste of time.
And Mike, we're talking about community association budgets, but you budget on a massive scale for an entire corporation. Right. That is on a much larger level, but the principles that you're guiding are exactly the same.
Yeah, I think that's really a good way to look at it, because you're never going to get 100% right, but it's educated, and it's an educated forecast. So let me go forward for you.
The last thing I'm just going to leave you with here is finally the reserve schedule. And state by state, this differs as far as what's required. And all I've done here is giving you examples of the way it's done. So this is both a GAAP presentation as well as a state of Florida presentation for reserve schedules. There's two different ways of taking care of your reserves or reporting your reserves. And it's the line item or component. They use, both words are used interchangeable. And that specifically just says you're going to list each of your component and you're going to allocate a cost and a reserve amount contribution every year by line. So if I want to put $8,000 into the roof replacement, it's only going to go into the roof. It can only be used for the roof work. And I'm going to have my balance sheet and it's going to show, you know, my different components, and I'm going to put that money specifically. It'll all go into one single bank account, but I'll allocate for it separately by component, right? And this is the schedule that you would use. Next, Mike. The biggest problem that we have is associations have chosen to move to a cash flow or a pooled funding method, but they still use the old line item. You can't. If you've moved to a cash flow or pooled funding, you have to use the cash flow or pooled funding schedule to determine how much you should be funding for full funding. It's a completely different concept. It's a completely different calculation, right? In the table in front of you, which is the cash flow or pooled funding, you're going to still have your main components. You're going to have your component, you're going to have your total life, your estimated remaining, and the cost. Those four columns remain the same no matter which table or method that you're using. However, the funding of it becomes completely different. You're no longer allocating by line, you're simply allocating a total amount. And then when you're considering your funding contribution, which is in red, is listed below. And it's calculated on a global or gross basis by year, right? So just keep in mind when you're doing your reserve schedule, make sure you're using the correct schedule, okay? I think that's it, Mike. Let's see what the next one is. That's it, conclusion. So look, budgeting is lots of fun. You know, I have associations that I can literally, I've worked with managers for a dozen years, and we can sit on a virtual call and crank out a budget in about an hour. They get their stuff put together. I have my stuff, the template already built. And then I have others. I have a new association that we just took on, 500, 600 units. And we sat for 3.5 hours with the president and the manager to prepare the budget in a draft for the first time. And it took 3.5 hours because I've never done their budget before. It's a $4.5 million budget for a 500-600 unit association. And I needed to understand it. I needed to understand what every line was, and I needed to challenge them on, you know, what the basis was for every number that they presented. So it took a lot longer. I guarantee you next year it'll take half that time. By the way, as of this morning, the manager sent me the 4th revision to the budget, and he and I created the 5th revision that has gone from 23% increase down to a 10.2% increase. Good luck to that association. Their insurance, they're $4.5 million, and their insurance increase is $299,000. Yeah.
Ouch. Ouch.
But we can all tell wonderful war stories in the world of community associations. So
yeah, it's certainly true.
Mike, I've enjoyed having the opportunity to kind of present this today, and it's been a lot of fun. There's just so much that we see, and the ability to be able to share that and kind of bring out some of my thoughts from what I see has been great.
Yeah, no, and I'll speak on behalf of the attendees. I think just a lot of these tips, some of them are, you know, and like most good tips are, some of them are kind of common sense. Some of them are also just kind of really good best practices. You know, I think about kind of, you know, budgeting the income, you know, conservatively, budgeting the expenses realistically. You know, I think about adding a line item mid-year, like, you know, do it judiciously, but don't be afraid to do it. I think these are really good tips that I'm taking my notes on my side that I think are really helpful. And we're right up at the top of the hour, so let's do this. I would say we do Q&A. Again, I apologize, we're having a little bit of technical difficulty today with GoToWebinar. But if you did put a question in the little chat panel, our team will jump in there after the event today, go through it, and we'll try to get back to you as quick as we can. So again, our apologies today. And if you like today, we do have another webinar coming up in about 2 weeks, featuring Classic Management, 3,000 door management company, talking about how they've reduced their operating expense, how they've been able to reduce their labor expense, improve some of their business processes. So again, there's links that we can send to everybody as well to kind of give you an opportunity to sign up for that. So on behalf of TOPS, on behalf of Vishnu, again, thanks Vishnu. Thank you all for making time in your busy day to join us online. We hope you walked away with some nuggets that'll help you in this budget season. And of course, if we can ever be helpful in any way, please just reach out to us. Let us know we are here as your partner. We want to help. So thank you all. Thank you, everybody. Hope to see you online at our next webinar. All right, bye-bye.